I said there's VC funds come in different sizes. The smallest thing that would count as in this space would be an SPV, which stands for Special Purpose Vehicle. It would literally be a fund, usually an LLC, that would be created so that 2 or 3 or 4 or more investors can make a pool of capital to make one investment in one company. And so I run a bunch of these SPVs. The first one I ever ran was actually a prize fund. It was for Social Venture Partners Fast Pitch. So we actually didn't even know what we were investing in, but 16, 17 investors all tossed in $10,000 a piece. I think the first one was $11,000 a piece. And then we set aside some of that money to run the fund because it takes money to run an LLC. And the oldest of these are 8 years old, and we're almost out of that money. The next size up of funds, we would generally call a seed fund. And it might be $500,000, but there isn't enough money in a seed fund to do a 2 and 20 model. Kind of what sets it aside from anything else is that seed funds have somebody in charge of making the investments. Sometimes it's the LP, sometimes it's the investors, because 2% of $5 million is $200,000. Right? No, sorry, it's $100,000. That's not quite enough to actually have a staff to run a fund. So seed funds are generally run because people really want them to exist. Sometimes they're run so that people get experience on running a fund so they can go off and do a bigger fund later. And when I showed you that diagram saying fund 1, fund 2, fund 3, fund 4, typically, historically, each fund gets started about 3 years apart. So if you really want to be a VC and say, great, I'm going to go to my network, I'm going to go raise $1 million into a seed fund, you're going to do that basically for nothing, right? For no, you'll take enough money out of there to pay for the legal costs, but you're not going to take a salary. And then you might do that because you really aspire to run an actual venture capital fund. And after you have 3 years experience running the seed fund, you might be able to go raise, 20, 25, $30 million or more. The early stage funds, the real venture capital funds, the traditional funds, smallest would be $25 million. That's where 2 and 20 starts to make some sense. Typically, though, they're more like $100, $200, $300 million. If we go way back in time, back to the 60s, the first venture capital fund was $3 million nominally. I think they only closed 2. But by the time we got to the 80s and 90s, the funds were typically tens of millions of dollars. By the time we got to the dot-com bubble, the norm was $200 million. During the dot-com bubble, the norm was more like $300, $400,000. Sorry, $300, $400 million. And then here we are in the 21st century. And again, the typical venture capital fund is a few $100 million, up to about $1 billion. And then there's something new that showed up in a post-dot-com bubble. And that's generally, they're calling them opportunity funds, growth stage funds. The most famous of these is the SoftBank Vision Fund. But there's some other copycats of that. And the SoftBank Vision Fund is like $100 billion. It's a totally different beast. It's humongous. It's the fund that put up all the money for Uber, not all, but nearly all the money for Uber and WeWork and a whole bunch of other companies. And their theorem, the reason why these funds showed up is because it became really hard to do an IPO. So the dot-com bubble, after it burst, it became, the public markets became worrisome of early companies, 3, 4, 5-year-old companies or younger. The public markets expected that companies going public would have profits or revenues, which is not an unheard of thing to do. But then what really put a nail in the coffin to the IPO market was Enron. So Enron had its huge, biggest bankruptcy in American history, huge amount of fraud. The DC response to Enron was a set of laws called Sarbanes-Oxley, which just make it wickedly expensive to be a public company. And so what's happened is instead of companies going public when they're profitable and growing and $100 million of revenue, and so all of a sudden they stayed with private investors, and these opportunity funds showed up to be that funding. And so these funds can write $1 billion check or $2 billion check or even a $10 billion check. They're humongous. And so when we map it back to this graph that we showed, many, many weeks ago, these SPVs are really taking the place of angels. They really are angels. They're a bunch of angels who are pooling together because it's easier to write one check to a company, or it's easier for one person who knows one experienced investor to manage the funds of some inexperienced investors, or it's a prize fund like I'm running. These seed funds, they act like angels as well. The check sizes they write are typically around the same size as angels, maybe a little bit bigger at times, but they kind of play with angels. They're usually in the same round as angels. They're not replacing angels. And then the early stage funds, they typically don't like to invest with angels. Maybe some that are smaller, but typically they want to invest with other venture capital funds. So they're waiting until the company's proven itself and it's on this upward slope. And they're writing, smallest check from a VC these days, a full scale $100, $200 million fund would be like $2 million. Like they don't want to deal with any company that can't put $2, $3, $4, $5 million to work. So they're in the growth phase, and we're not quite showing this, but they would overlap the opportunity funds in the growth phase. And then the opportunity funds, they have to write very, very large checks, $100 million, multiple hundreds of $1 million or $1 billion checks. So they're playing with the companies near the top of that growth curve. And then they may not sell the companies when they go public. All the other venture capital funds, the reason why I put early stage up to that dotted line is as soon as a company goes public, as soon as a venture-backed company goes public, as soon as that venture capital fund can sell the shares, they sell the shares and they get out. Venture capital funds don't buy public equities, don't own public equities. Now, strange thing about these VC funds, just historically, not because they have to, but just because this is the way they're run, is no matter how big they are, they make 15-ish to 20-ish investments. Maybe 25, and it may be 12. It may even be just 10. But it's typically around 15 investments per fund. So what I'll do when I see a new fund come along and they say they're $100 million, I will take 100 million divided by 15. And that's a pretty good estimate of how much money they're going to invest in each company. And if it's a billion dollar fund, right, versus 100 million, it doesn't mean they're going to do 10 times the investments. It's going to mean they're going to do 10 times the size of the investments. They're still going to make 15-ish investments per fund, right? And they may run a series of funds. That $1 billion fund may be fund 3 or 4, and the previous one might have been $500 million. And the one before that might have been, $150 million. They tend to get bigger over time. But each of those specific funds is only going to make 15 or 20 investments. And the reason for that is the preferred equity structure. We talked about that in the revenue-based workshop. In the preferred equity structure, every investment comes with a board seat. And somebody has to sit on that board seat. And it has to be one of those general partners. And a general partner can realistically sit on 6 boards and do a good job, 7 or 8 boards and not do a great job. I know someone who has managed to sit on 12 boards and be totally stressed and do a great job on a lot of them and phone in on a few probably, or a few just didn't have very many board meetings. The limitation on the total number of investments is actually how many boards can a partner sit on and how many partners can a fund afford, because it's 2 and 20 for any of these funds. And so you just run out of space. As a VC, you're going to sit on the board for those 10 years that you're an investor, and then you expect to get out. You expect at some point the company gets acquired or goes IPO, and then you leave the board. So a space opens up after a while. I talked about the 10-year lifetime again, and some of these numbers in terms of how big they are in 10 years and 15 investments and so forth, a lot of that dates back before the dot-com bubble. So the norm in the venture capital world between the 60s and the mid-90s was that a startup would have 3 rounds of venture capital. And back then, there really wasn't seed investors. There were some angels around, but these seed funds didn't exist. They didn't pop up until about 10 years ago. And so back in the day, in the 70s, 80s, and early 90s, when a startup that was had a venture scale idea. They would go to a venture capitalist, they would pitch the idea and get funded with a Series A. And then a year, 18 months later, if it worked, right, they brought the product to market and there seemed to be some customers, they would get a Series B round and it'd be bigger if all was going well. And in general, even today, about half the companies that get a Series A get a Series B, half that get a Series B get a Series C, and so on. It's 50% attrition from stage to stage, and that's true now with that seed stage attached. So about half the seed stage companies get a Series A, half of those get a Series B, and so forth. And so the norm back then, pre-dot-com bubble, was 3 rounds of venture capital, 4-ish, 5-ish years. If everything went well, you went public. You did an IPO. There were fewer acquisitions back then because there were fewer companies that had done this, that had enough public shares and public valuation to be the acquirers. Now there's then we have decades of venture capital firms that buy venture capital backed companies. And so what happened, again, post Enron, which was 2001, so 2002, 2003, and so on to today, is now that IPO doesn't exist. And so Uber did like round G, I think. It might have been round H even. And WeWork got to round F at least and before they did their IPO or failed IPO. And so what's happened is more and more rounds of capital are needed. That's created those big, gigantic opportunity funds to be there to fill in those gaps of what was the IPO. As a fund manager, you have to try and guess now what the average number of rounds of capital will be. And except for the seed funds don't always participate in all these, but all the other ones do. So if you get funding from a full-scale venture capital firm as an entrepreneur, if you're running a full-scale venture capital, if you're running a full-scale venture capital fund, if you're one of those GPs, you have to figure out what's the normal number of rounds going to be now, and you have to put a budget. So when you say, yes, I want to invest in that company, and it's round A, well, you have to figure out, okay, if I'm going to write a check for $2 million in round A, and if all goes well, round B is going to be bigger. So I might need $3 million in round B, and then C could be way bigger. I might need $5 million in round C. So that's 2 plus 3 plus 5. I need $10 million budgeted for this company. What happens if it goes to round D and E and F and G? Where's that money going to come from? In the old days, it was pretty simple. It was 3 rounds and out, right? 3 rounds, and if it worked, great. And if it didn't work, it would fail at that point or become a zombie. And now we don't know. There is no normal number of rounds. So the budgeting gets really complicated these days.